Good morning. You're watching live market outlook for Wednesday, 9th of November 2011, prepared by Windsor Brokers. Yesterday's awaited voting in the Italian Parliament gave expected result. Actually, the Parliament voted for the budget of Italy. However, the President Berlusconi, as widely expected, lost the majority in the Parliament, and he offered his resignation. He became the biggest political casualty so far in Europe's debt crisis when he announced that he would step down after being stripped of his majority in the Parliament. Berlusconi also said he would leave office after Parliament approves budget law that includes reforms demanded by Europe, which is now struggling to prevent the debt crisis from spreading to the third largest economy, Italy, using the Eurozone single currency. The Greece, which is now the ground zero of the crisis, is scrambling to win emergency funds to avert pending bankruptcy as soon as the next month. And the political parties now are arguing over a new coalition government to replace the previous one of the now former Prime Minister George Papandreou, who has also announced this week that he will step down. Berlusconi's departure spells the end of the flamboyant billionaire media magnate's 17-year dominance of his country. His failure to implement reforms fueled the party revolt, and votes on the budget measures and his resignations could come as soon as this month. He actually announced on his own TV station that the only option now was an early election, which could prolong the uncertainty that has sapped the market confidence. The Italian president would hold consultations on the formation of the new government, and is thought to favor a technocrat or a national unity government for Italy, similar to the solution being put in place for Greece. That would actually please markets that have driven the cost of borrowing from Italy's government to 14-year high. Traders pushed the yield on benchmark 10-year Italian bonds to 6.79%, a level last seen in 1997. And such levels effectively make it unaffordable for Italy to continue to finance its own debt, and are similar to levels that forced Ireland, Greece and Portugal to take bailouts. Italy, however, is widely regarded as being too big to bail out. The Berlusconi's government won a budget vote on yesterday after the opposition abstained, but it secured only 308 votes in the 630-seat lower house, 8 short of majority. So this was actually a signal of the end of era of Berlusconi in the Italian parliament for now. Some good news came from Germany, as strong industrial output helped the German economy to gain pace in the third quarter after the momentum slowed in the second quarter, but worsening of the Eurozone debt crisis is lowering the confidence and would likely impact the performance ahead. The new orders, particularly of larger investment goods, are already declining and starting to weigh on output, while the construction sector is also suffering weaker demand, likely to result in a subdued fourth quarter for manufacturing. All in all, momentum in the coming months is set to be very subdued. Gradually, the global economy could start to pick up. From the second quarter of 2002, we might see a gradual recovery of the dampening effects of the Eurozone debt crisis recede. That was the comment of the Ministry of Economy of Germany. From the other side, the Chinese CPI announced earlier today rose 5.5% on a yearly basis, and it came in line with the forecast. The immediate impact was pushing the crude oil prices higher, as the cooling Chinese inflation suggested the Beijing had room to ease monetary policy and spark demand to reduce fears of the sharp slowdown in the world. Second largest oil consumer, that was basically widely expected. On the other side, gold also remains steady, well supported by current debt crisis, acting as a main safe haven instrument, and last night's rally regained $1,800 per ounce level. Currently gold is in the consolidating mode, but price action in the short term remains quite steady. For today, calendar shows after the announcement of Chinese CPI, as we mentioned earlier, and industrial production that came broadly along with the expectations, slightly lower than expectation. The next to come is at 9:30 the UK trade balance that is showing the widening of the gap by £8 billion compared to gap of £7.8 billion in the previous month. And then from US we have at 1500 GMT wholesale inventories monthly, a slight improvement at 0.5%, which is today's forecast, compared to 0.4% the previous month release. And then the crude oil inventories, US crude oil, weekly crude oil inventories due at 1530 GMT. Forecast for today is a build of approximately 700,000 barrels compared to the previous week's build of 1.8 million barrels. This was from today's calendar. Now let's take a look on the charts and see the latest movements of the market. As we can see, the euro remains steady, still holding within the recent range. The upside stays capped at 138.50-70 zone, which is the 38.2 Fibonacci retracement of the down move from 142.46 to 136.07. Brief dent of the 138.50 overnight, seen overnight, to 138.57 keeps the sentiment positive. Current pullback is seen on the corrective, as long as the initial supports at 137.65.50 hold, where also stands the 20-day with the 137.65.50 expected to hold, where also stands the short-term bull trend line drawn from 136.07, currently standing at 137.45, and reversal above these levels is actually required to hold the current positive tone. However, the clearance of the upside strong barriers at 138.50-70 zone is required to resume higher, and the next levels are at 139, and then Fibonacci level of 50% at 139.25. Also 40 zone is in sight in case of break, that marks 61.8 Fibonacci retracement level, and also the 90 days simple moving average on the daily chart. And actually this is acting as a next very strong resistance. On the downside, euro, as mentioned, the initial supports at 138.65. The next level comes at 137.23, yesterday's low, and then have series of 137, 137, 136, while the key support still remains at 136.55, likely to refocus 136.7. So for the near-term outlook, the euro-dollar still holds the positive tone while holding above 137.50 initial support zone. The British pound holds its positive tone after a break above the previous resistance zone at 160, 60, 70, where the pair was congested for a couple of days. Fresh rally through 161 barrier, extended so far to 161.29, just ahead of our initial barrier 161.40, which is daily 200 days moving average, and the previous high at 161.64. The current sentiment remains positive, as the corrective pullback from yesterday's high at 161.29 so far found support at 160.64. It was just ahead of our initial downside targets at 160.34 and 160 zone as a key psychological support at this point, holding above which is required to maintain this strength. However, the support was found just ahead of this and just above 20 days moving average, currently standing at 160.47. Focus is again on the upside. Break above 161.29 opens the levels, as mentioned earlier, 161.40 and 161.64, above which comes 61.8 Fibonacci retracement at 161.79, above which would open way for a possible extension further up, and they open next highs at 163, 160.40. Dollar yen is losing traction after a break below 78 as initial support, and also strong level at 77.75, extended losses to 77.50, which marks the 50% Fibonacci retracement of the post-intervention 75.56, 79.52 rally. And the downside, the immediate risk is at the downside, as the downside now is vulnerable for further losses, for possible return to the previous August-September range between 76 and 77 levels. However, comments from Japanese finance minister that they are going to act to prevent further strengthening of the yen, released last night, are keeping the possibilities of fresh intervention of Bank of Japan still on the table, and this is pending for now. Our initial trigger was around 77, 75, 77.50. However, the Bank of Japan hasn't reacted yet, but this is quite likely and pending at any time. Also need to mention that after the main intervention that occurred on the 31st of October, there were several few smaller by quantity of money in the market at that time that kept the pair stable around 78 zone. However, as the pair is losing traction at today and late yesterday, we might see some further action of the Bank of Japan. On the upside, the gain of 78 and 78.25 is required to stabilize the short-term price action, but clearance of 78.44, 79 is to focus higher and then open the levels of 79.52, which is post-intervention high, and then 200 days simply moving average at 79.76 ahead of 80.00 as a psychological barrier. Dollar Swiss also maintains a positive short-term tone after extending gains to 90.66 yesterday, with corrective pullback finding support at 89.20, just above 89.00, our projected support level, as yesterday we lost initial support at 89.57, and our projection was for 89 to hold the dips. The support was found also where the 20 days moving average was standing at that time at 89.17, 89.20 zone, and the fresh strengthening is now underway. Immediate focus is at 90 as a psychological barrier, above which opens 90.66, yesterday's high, and break here to focus our targets at 90.81 and 91.20, which are the mid-October's highs, and possible further extension higher. The daily outlook is now regaining strength. As we can see, the studies are breaking above their midlines, and the golden cross at 87.24, where the 55 days moving average crossed above 200 days moving average, is now giving additional support to the pair, with the 20 days daily moving average at 88.64 currently underpinning the advance. Short-term focus based on the daily studies is still on the upside, and the possible test of 93.13, 6th of October recent high, is in the short-term focus for now. As mentioned in the introduction, the gold remains steady after extending rally to hit fresh high at 18.02 in the late hours of yesterday's US session, maintaining the positive short-term tone and looking for further extension higher. Current corrective pullback on overbought conditions looks for a initial support at 1778, dynamic support, and also the previous low of yesterday's intraday low, ahead of strong support at 1750 zone, which is actually breakpoint at currently breakpoint, and the only loss of 1750 would delay immediate bulls in favor of deeper correction ahead. On the upside, clearance of 1800, which is also close to 61.8% of the Fibonacci retracement of the broader 1920 1532 decline, opens way for a test of the next barrier at 1828 and then 1845. Crude oil is also in the strong uptrend after extending gains yesterday, posting fresh high at 97.30 en route to our initial target at $100 per barrel. Currently, the fundamentals actually have driven the oil prices, as mentioned earlier, after positive Chinese CPI data removed immediate fears of slowing down of the Chinese economy and reducing the oil demand. The oil prices are now in the fresh strength. Corrective pullback now on the overbought near-term conditions is underway, with initial support at 96 and 95.60 zone and 95, above which the reversal should occur in order to maintain the current positive tone. Upside, as mentioned, 61.8% Fibonacci retracement of the broader downtrend from 114.80 to 74.94. Currently at 99.45's initial target, ahead of psychological 100 and 100.60, the high of July 2011. Also significant on the daily break above 200 days moving average, that's currently standard 95.22 and is underpinning the current advance.